thank you guys for joining us this morning and welcome to another episode of Blockchain Banter. Unpopular opinions. We're going to be kind of debating, discussing different DeFi, I guess, current events, if you could call them that, hot takes for sure. We've got Joshua Baker here, the CEO at Aori, and Dr. Mark Richardson, project lead at CarbonDeFi and Bancor. Thanks, guys, for joining us. DeFi Cheetah is going to be joining us. He's just going to be a little bit late today. So, Josh, I am going to throw one at you this morning because I saw a tweet of yours. I want to say maybe a week ago or so. First, I kind of want you, for anybody who's unfamiliar with your background and options, maybe you might give us a little bit of info on that while I pin this to the top because this will be relevant in our discussion today.
Yeah. So, previously worked in crypto market making. Did that for about 2.5 years. I was kind of part at System 9 of helping, start their options desk. So that meant building out the strategies for trading options on chain. So that's on protocols like Lyra, Premia, Deribit, or Hedgic, as well as the centralized side with Deribit and Paradigm, as well as working with different OTC brokers on any block trades off chain or anything like that. Um, I worked really closely with Peter, a very good friend of mine, the CEO of System 9, who he was previously an options market maker at the Chicago Board of Trade and Chicago Merc for 20 plus years. So yeah, that was how I kind of got started in options and kind of what my background in it. Yeah.
Okay, awesome. Thank you so much. So maybe I pin this to the top. Maybe you can give us, and Mark, I want to hear your opinion on this as well, right? So obviously, to just jump in here whenever you'd like. Um, but you see the tweet that I have pinned to the top there. Maybe you wouldn't mind kind of just explaining I mean, I think I think anybody who's reading the tweet can kind of see what your, end take is on this. But maybe you can give us a little bit as to you think that if you LP, now are you speaking to constant product? Are you speaking to concentrated liquidity? What is it that you're actually referring to? And then I kind of want to dive in a little bit. There was a tweet that I saw that I think you might find interesting and I found really relevant to what you were saying.
The topic of the last couple of days on this side of Twitter was LVR and Ion, all that. So I wanted to immediately address that. This is a bit aggressive of a tweet, but my general take is just anytime you're making conscious sacrifices about trading as a user, whether you're a maker or a taker, there are major risks when doing it on chain. Those risks on the making side on any kind of AMM, no matter what the curve is, no matter if it's inverted, no matter if it's a constant product, no matter if it's a stable curve pool on curve, any product in which you are guaranteeing that you are going to be providing liquidity every trade, you will inevitably you will have your liquidity position taken advantage of. If someone knows that they can force you to do something, with your money, then they have an edge on you always. You can do cute things like hedging it and all that, but it all kind of leads to the same route of, you two are in a war to constantly fight over hedging versus your position management, and you're always fighting like a defensive losing battle. So that's why I'm not a fan of LPing of any kind. I think I've kind of made this point too on a couple other tweets where it's I can completely see exceptions and things like just in time liquidity, but eventually even just in time liquidity doesn't make any sense when you realize that it's a purely reactionary trading strategy. It's basically just saying ooh, I know that there's going to be 20 trades coming in at these price levels. But if no one's LPing, then just-in-time liquidity will never come, because like there will never be a desire for that liquidity to be provided intra-block, at those price levels. It's very akin to something in TradFi called last look market making, where whenever you're last look market making in TradFi, for anybody who doesn't know, it's very, very similar to just in time liquidity, where you as a maker post an order. So on this in on Uniswap, that would be basically you provide liquidity. Then the taker comes along and fills your order. Or multiple people fill your order at different sizes, something like that. And then this would be a trade coming into Uniswap, and then you, as the maker of the order, actually get the opportunity to look again at the current price, on different exchanges. You get to look at the Binance price, you get to look at the Coinbase price, and then you get to decide, do I actually want to provide that liquidity, or do I want to like cancel my order now and not actually fill it? That's really like what Uniswap eventually will become, is just that. And that will lead to bad prices for everyone. Um, and then the trading side for takers is just pretty obvious. You get sandwich attacked all the time. It's really easy to. You can do cute things like MEV protection with flashbots and whatnot. But it's got its trade-offs as well. But yeah, that's I'm rambling. So
It's a good ramble. Like, if that's if that's the quality of your rambling, I implore you to do it more often.
Thank you.
Yeah, so there's a couple of talking points here that I want to address. So I don't have like as extreme a view as Josh does, but that's not to say that I disagree with anything that he said. I think that there has been probably maybe I want to say too much focus on this concept of like making AMMs profitable for LPs, and like obviously that's a totally legitimate field of research, but I'd say that the book has kind of been closed on it. It's weird to see all of this LVR stuff and speaking about AMMs as like options protocols when this work was completed years ago. There hasn't really been anything new. Like it's interesting to see some of these concepts get revisited, but even when people are kind of saying like, have a look at this new, like brand new paper, and I've got this new insight, and you read it and it's like there's absolutely nothing in there that we wasn't I thought saturating knowledge this time at the end of 2020. So I feel like people are either rediscovering the same concept over and over again, or they have like literally actually discovered the old literature and they're kind of dusting it off and trying to pass it off of their own. I'm not sure which. Maybe it's a mixture of these two things. It's not clear to me. But and I have been active in that kind of research. I remember when Uniswap v3 came out, it was it wasn't well characterized what the payoff and risk profiles actually looked like. And myself and Stefan Loesch and Nick Welsh spent a long time like scraping data from the chain and actually doing like a first principles empirical analysis of what the returns profile actually looked like and whether or not it was a profitable endeavor. And a lot of people don't know this, but we had a very pragmatic approach. The idea there is that if you're putting liquidity inside a range, that if you're providing both sides of that strategy, then you should be happy. Like we assumed that people were actually happy to keep that position. So we basically ended the IL calculations at the second, like the actual block where the liquidity left that user's range. And we used that to basically set a floor for the IL calculation. And the reason why we did it that way was because you don't actually know, right? There is a legitimate argument for saying that, yeah, maybe the user does like this position. You know, like if they put their liquidity at that point and they ended up entirely in USDC, or if they ended up entirely in ETH or whatever the token is, you can't necessarily make the decision for them from an analytical perspective that this is something that they were disappointed in. Of course, many people would be disappointed, and having their liquidity being taken as a part of the toxic flow process could be something that that they would count as an overall loss. But I also consider it as like a bad trading decision. Like there are many people that have bought ETH at a much higher price than what its price is right now. Bitcoin as well, maybe all tokens right now. There are going to be a bunch of people that are underwater. But on a spot trade, you can make this exact same calculation that you do on an AMM. It's not, we treat IL as if it's something exotic, or this LVR as if it's something exotic, and it's not. It's really just that you agreed to buy something at a particular price, and if the market happens to move away from the price that you bought it at, then so be it. But the point that I'm trying to make here, I think, is still in line with what Josh is saying. Just that you can take two different and both legitimate perspectives on it. One is the viewpoint that Josh is expressing, and the one that has kind of dominated the discussion recently, which is that if you consider an AMM to be itself a financially performant vehicle, then there are like very severe shortcomings to that analysis, and maybe that's something that we need to address. And like I said, I think that the book has already been closed on that. But then the second one is that, well, maybe it doesn't need to be a financially performant vehicle. Like maybe it is a way to get into and out of positions by essentially using AMMs as a subset of an order book. And that's also a legitimate perspective. And while the IL calculations and stuff that kind of dominate the analysis is still valid, you can't necessarily assume that 100% of the people that have been a part of that process are necessarily disappointed in it. I'm sure that it's a high proportion, and the assumption that we made, which is that 0% were disappointed with it, and we still ended up with, it still wasn't a flattering analysis, but it was a lot more flattering than had we actually continued to calculate IL after the range had exited. So yeah, it's more than one way to look at it, and it's not necessarily that anyone's right or wrong. It's just different perspectives on the same topic.
Yeah, I definitely agree. Yeah, I just one small caveat is maybe I would have a much kinder analysis similar to yourself, or maybe would be willing to have that perspective more if and I'm not gonna I mean people will kind of understand what I'm saying, but like if the proponents of LPs weren't like writing the most clickbait air quote research claiming that AMMs are this spectacular new financial primitive that are like just God put them on earth to be the greatest places to put your money possible. It's like, come on, man. Like, I hate that crap. When you're lying to users or obfuscating the truth to them when their life savings is on the line, like, this is fucking ridiculous. So yeah, pardon my French, but yeah.
No, it's fine, and I agree with you. Like misrepresenting what the actual I like. Can we phrase it as that there's nothing necessarily wrong with an AMM position, but if you tell someone that like this is a money printer, then that's kind of crossing a line.
Yeah, that's disgusting, and you should be I mean thrown in jail is like maybe I'm a bit extreme. I'm a bit draconian, but I'm very much leaning towards it.
So let me ask you guys this then. I pinned to the top another tweet, and this is kind of where, excuse me, I was going with yours, Josh. Guillaume, who is one of the co-founders of Panoptic, tweeted, and I think he really came on my radar when he did his kind of walkthrough of how you can LP on UniV3 when concentrated liquidity was first kind of really a big talking point, right? A lot of people were trying to understand this. And he's saying LPs, as a retail level LP, it hasn't been his experience that LPs in UniV3 are losing millions per year and that you have to be a pro to do this. And IL, LVR, just-in-time liquidity, and MEV, which you guys have all mentioned, are demystified as long as you look at LPing like selling options. This is where I was, why I was asking about your background in options. This seems to, I mean, I definitely want to hear what you have to say, what your take on this is, especially considering, your background and your current project. So maybe you can kind of, I don't know if you saw this tweet, but
Oh yeah. I actually, if I don't know how to. Maybe I'll like share it into the chat. Yeah, here we go. I think I shared it. I would highly recommend everybody read this thread by Scoopy. Scoopy's the if you haven't followed, I'd highly recommend following him, or Snoopy. Sorry, Scoopy, someone else. My bad. Snoopy. This is an amazing thread if you can or follow him. But
Josh,
effectively, what? Sorry,
good.
sorry.
Did you share this with me somewhere or?
Oh no, I shared it in the spaces, but I think the guy's locked, so you'll have to request to follow him. I'd highly recommend it. Snoopy's a great Mev trader, um, who wrote a tweet to this to the original, the Gyame, if I'm saying that correctly. Uh,
Yeah.
LPs are losing millions per year post. I think Snoopy kind of makes the argument that, like Gyame, I believe. Yeah, Gyame is making this claim that, like, financial markets are something that you can solve. Like, financial markets are something like this is like a game. It's solvable. If you just are clever enough, you can solve this problem. And like, it's like no. I had a really amazing researcher one time tell me, you know, risk is like the conservation of mass. Like, you can just move things around, but they're always going to stay constant. Um, so or in the yeah, so like I think the same applies to risk in finance as it does to mass, wherein there will always be a constant amount of risk in a market. You can be really cute and move it around in different ways, but that doesn't change the fact that your risk is always, there and constant, or it can be shifted onto someone else. And while things like Panoptic, I think are a great, they're great gauze. They're basically Panoptic, for people who don't know, is a protocol where you can hedge your LP positions, which if you kind of map the payoff of an LP position, it's very similar to that of being short two kind of weirdly convex um, options. So you're short. So if it's kind of like you're selling an ETH call, and you're selling an ETH put if you are, have an ETH USDC LP position. That's kind of how it actually maps out on a chart. Um, it's really close to that of like an option, but instead of like a perfect line, it's curved, because of the AMM curve, of course. Um, and Panoptic allows you to hedge that by using their protocol, and I think that's an amazing idea. But the problem is you're not, again, as kind of Mark alluded to earlier, you're not making your position profitable. You're just paying to hedge it. And in an efficient market, the cost of hedging your LP position will at minimum be the price it is, the amount of fees that you're getting paid. So while you're de-risking yourself, in terms of not being long or short anymore, this LP position, you lose all of the P&L, and you might actually lose money paying to hedge it. So I think that's kind of like a really big misconception. And even still, more of the AMM people are kind of like shilling this idea that, oh, if you just hedge your position, this guarantees that you're going to print money because the fees are just going to roll into you. It's like, well, what happens if there's a week with no trades? What happens if there's like, a super low volatility market and there's no trades on your AMM and there's only arbitrages?
Or it's
And
it's
yeah,
not even that it's not even that there's no trades. Like in order to actually turn a fee, the price needs to go up and then down, right? Like if
yeah,
people
yeah,
actually
yeah. Well said.
right? Like there's no, like, there really isn't such thing as a fee in AMMs, and like, you know, I have a very like, this is trivial to demonstrate, because the way that AMMs operate is essentially the prototypical case is to always take the fee from the target asset, right? And it's the same in in Balancer they reverse it. They always take it from the source, and in Carbon's case, which isn't an AMM by the way, that it can be taken from either the target or the source token depending on which function is called. But that doesn't matter. The point is that the way that this manifests is that there is a price that you can sell at and there's a price that you can buy at, from the taker's perspective. And in the middle, there's no token liquidity, right? There's always like a price gap between these two things. And that is literally 100% identical, mathematically, computationally, heuristically, financially, however you want to break it down. It is identical to having a bid-ask spread. And so if you have a position and the price is only moving like up through a range and it never crosses that bid-ask spread back into the bids, then you actually don't earn any fees. The only way an AMM can make fees at all is if the price crosses that bid-ask spread, which is an important note because the way that AMMs report their profitability actually isn't contingent on that. They don't have that element in their reporting that actually shows that, you know, a lot of the you know, air quotes fees that have been accumulated, whether or not that was just based on volume or whether or not it is based on volatility. And the volatility one is the one that you care about. So a lot of the, you know, it should be noted that a lot of the fee revenue that's being reported in DeFi is actually massively overestimated. And I think if people took that into account, it would speak even more, like it makes Josh's argument even more compelling. Which is that, you know, you can maybe appropriately hedge it or whatever, but you're still likely to be like, the best that you can hope for is break even. And what's interesting about that perspective is that that's also essentially the default of not providing liquidity at all, right? Like at the end of the day, the benchmark to which we compare all AMM all AMM performance is the HODL position. And the fact that doing nothing in general is more profitable than providing liquidity, and that all of these like fancy hedging capabilities and things that are being built on top of it are trying to get back to the, you know, at least break even, is, you know, it's deeply concerning. It's deeply concerning.
Oh yeah.
But that's only if you have the assumption that the AMM position is supposed to, you know, be a lazy, you know, a lazy source of value for the people that are providing liquidity. And I don't think that that's a realistic expectation. If you treat them just as a way to exit and enter different positions based on market movements, that's totally, like I said before, it's totally legitimate. I don't argue against people that espouse that. But I think the position that Josh is speaking from and why he feels so strongly about it, and I do too, is that it's not being marketed that way, right? We don't have that type of conversation. When you hear people talking about liquidity provision, they talk about AMMs and new DEX protocols and all of these things, it's always about, you know, how much money you can make by being a liquidity provider. And the reality is it's not zero, it's less than zero. There is the cost to providing liquidity. And you can be happy to pay that cost if it means that you get into a position that you're happy with. But the only way that this position, that you know, if you're going to take this stance on the topic, the only way it can make sense is that if that's the information that you're providing your users with. And so if you're not providing your information, providing that appropriate information, and you are convincing your users that this is just a way to you know, to get money for staking tokens in a protocol, then it's a, you know, it's an argument without a legitimate defense.
I pinned another to the top since we're speaking about risk. This was that they're really not comparable. Josh, you said that the risk is always there, just kind of gets shifted a little bit. And Mark, if I'm understanding correctly, you're saying there's more risk in LPing than just hodling, right? Do you guys agree?
Yeah, absolutely. Yeah, of course.
And in
Yeah, you basically amplify it. So the way that I described AMMs recently, and the one that seems to be sort of resonating with people a little bit more, is that like we can describe it as an option. It's totally, that's fine. If assuming that most people understand what options are and how to use them, which they don't, right? I find that there is something oxymoronic about saying demystifying LP positions by describing them as options. Like this, it really appeals to a very narrow subset of people that are actually using these protocols. The one that I've used instead is the insurance perspective, right? If you say that what you're actually buying or what you're selling when you provide liquidity is insurance to the market against any type of price movement, right? Imagine that you're at a casino or something, and there's a game where you can basically place a bet that the price of Bitcoin doesn't move, right? That if it's at whatever the price is, that this time next week it's going to be roughly that same price, and we don't care about what happens in the middle. That is essentially the bet that you're taking. And I think if more people understood that that is essentially the option that you're buying, that is the insurance contract that you're signing when you provide liquidity to an AMM, more people would probably be reluctant to sign that contract.
Oh, also, I love that tweet. Shout out to Keone. Keone over at Monad. It's awesome. Monad's awesome. Yeah, he's totally right. Like we kind of talked about this actually a couple days ago on a space. Yeah, he's Keone. For anybody who's kind of curious, he's the co-founder of Monad. He was at Jump for 9 years, I think, 8 or 9 years. And he's a spectacular quant. So anything he says about trading, I would listen.
Mark, you said that it really appeals to a narrow subset of those using this type of concentrated liquidity AMM. So I guess that's another another question that I have for you. And I don't want to harp on Guillaume. It's just he created this thread, it got all of this engagement, and he started it out with retail LPs. Who do you think then, if it's speaking to such a narrow subset of those using this type of AMM, is it retail LPs? What do you even consider retail LPs?
Well, that's a good question. I'm not entirely sure. Like, Panoptic is a really great idea. It doesn't have a lot of traction, and I think, and that's fine, right? We know that new protocols can take a little while to sort of build a following and a user base, and that's I don't want anyone to think that I'm bad mouthing or criticizing Panoptic. I'm just observing that it doesn't have a lot of users yet. And I even spoke to like when I was speaking to Kirok in Paris during ETC, they said that when they actually spoke to Jesper, who's sort of leading a lot of the efforts at Panoptic right now, that it actually did make more sense to them, and they were slightly more interested in the product, and that they think that a lot of this, like describing it as an option and these kinds of things, might be sort of a little off-putting. I think for Guillaume, who has spent a huge amount of time understanding and digesting the financial markets, and Guillaume is an unusually intelligent person. He's he belongs to the far right of the IQ curve, right? He was a assistant professor at Cornell until recently. The type of stuff that he was doing in biophysics is the absolute cream of the scientific community, right? It's very, very difficult. You need to have a very profound capacity for learning in order to achieve the things that he has achieved. And Panoptic feels a little bit like that. I think in order to appreciate the product for what it is, and to really understand it and what it allows you to do, requires a level of erudition that I just don't think the majority of DeFi users have. The underlying assumption, I think, for Panoptic is that there are people that are using Uniswap v3 en masse for its like implicit use case, which is to provide liquidity in a certain price range and try and earn as much money as possible from price fluctuations without exposing yourself to too much upside, or without exposing yourself to too much downside risk from LVR, and that's okay. But how good is that assumption? Right? Like I think I would espouse that I think the majority of people that kind of came into DeFi and were using Uniswap v2 before Uniswap v3 was released was predominantly for liquidity mining rewards and token incentives and other things, or maybe even just to become to feel more part of that kind of culture, right? When everyone is excited about what's happening on Ethereum, and these are the kinds of things that you can do. I think people do want to participate for its own sake, and that's okay. But I think that when you put something as sophisticated as an options hedging protocol in their hands, a lot of people might look at it and think, I was really just here because I was getting token incentives from my favorite project for doing something that they asked me to do. And that, I don't understand what I was doing in the AMM to begin with. And, before I even understand that, what is the likelihood that I'm going to be able to understand how to hedge it correctly and so on? And it's understandable. I think for a lot of people, crypto is a hobby or like an interest, like not even a side gig, just something that they kind of occupy themselves with occasionally on weekends or something, which is fine. Like, again, not critical of that. But I don't think that they have the time necessarily, or in some cases, maybe not even the capacity to understand these kinds of advanced, financial products. And so, if we assume that there is a small minority of people that are using AMMs that actually do have the capacity to understand this, whatever that small minority is, you're not going to be able to capture all of it, right? There will always be some percentage, less than 100, that is going to be the kind of people that do understand Uniswap v3, are using it, and want to use this specific hedging strategy in order to become delta neutral or whatever it is they're trying to do. And so I think it just is a diminishingly small wedge of the market, and I think that. Some people may, disagree with that analysis, but I think that the numbers are kind of speaking for themselves.
Yeah, that does make a lot of sense. Like it did seem like they put the cart before the horse a little bit on that. Yeah.
We have about 5 minutes left. I want to, Josh, give you a minute to speak to Aori and Mark to speak to Carbon a little bit, because since we're on the topic of concentrated liquidity AMMs and different types of trading, specifically, right, options, I want to be able to speak to a couple of, specifically the projects that you both represent, if you wouldn't mind.
Yeah, absolutely. So I guess Aori is, I would almost call it like mostly decentralized, but hybrid model DEX, where we have a high frequency off chain order book with decentralized on chain settlement. We are about to drop spot, and then as alluded to, options are coming likely later this year, maybe early next year. Yeah, I think kind of the core thesis of Aori is just that like the current trading system surrounding AMMs is mostly broken, kind of for the reasons we alluded to on this call, or on this space. I'm definitely, as you would say, an order book maxi. Admittedly, with full transparency, I do believe that actually AMMs are the best in like new low liquidity markets. Or liquidity provider positions. They definitely make sense. In like newer markets, just where you don't have something like a sophisticated market maker or people running market making strategies in an order book. It definitely provides a ton of value there. But once your token or the token starts to scale in liquidity to the point where there are actually people who are able to provide liquidity in an order book, that is infinitely a more sustainable solution. So I just want to see the transition, of of the high market cap trading or the high volume. I think there's a lot of really innovative solutions like Carbon and Aori that kind of solution. So yeah, thank you.
Thank you so much. And I definitely pinned some info to the top. Mark, if you wouldn't mind giving us an I wouldn't say your elevator pitch, right? But tell us a little bit about.
No, no, I'll keep it like relevant to the discussion. So the fundamental design principle I think behind Carbon is that that the AMM is specifically, and I have speaking from the leadership position at Carbon, some authority to speak to why AMMs were invented, because we invented them. The idea was that if a new project wants to bootstrap de facto liquidity for their token, they should do it themselves. And to Josh's point, AMMs are absolutely well suited to that specific use case. When you when you fire up a liquidity pool on let's say Uniswap v2, and put a bunch of your project's tokens in it, besides ETH or USDT or whatever you want, and allow the market to to interact with that liquidity pool, it's totally fine. It does do a really good job of that. But from the user perspective, from the people that are actually trying to make trading decisions, I think that the prescriptive model that that an AMM represents, whether we call it the short gamma option or the rebalancing trading style, whatever your preferred terminology is, they all mean the same thing eventually. I don't think that this is speaking to or should appeal to much of how the crypto community treats the tokens that they trade with. In general, when someone is entering a position, like let's say someone is buying Bitcoin today, the reason that they're buying it, fundamentally, I would say in near 100% of cases, is because they have an ambition to sell it back to the market when its price is higher. That is, I would hope, not a controversial statement. The same is true of ETH. The same is true for almost all governance tokens. Of course, there are reasons for people to buy governance tokens to participate in the project that they are helping to govern. But in general, people are profit motivated. And so to decide that there's a price that you like, that you are happy to buy something at, and another price that you also like, that you're happy to sell something at, I think is a very natural expression of how traders think and choose to interact with things. The problem is that typically in DeFi, the only way that you could have that view of the market was to take liquidity, right? Was to to spot trade on AMMs. And as we've seen over the last couple of weeks, there is kind of a growing attention paid to things like sandwich attacks. You might have seen on from Glassnode that about 60% of the volume on Uniswap v3 is now attributed to sandwich attacks. I recently wrote an article. It's on my Medium.
Wait, I'm sorry. What percentage? Sorry.
60.
Holy! Oh, sorry. Please continue. My bad. I had to make sure I heard that right.
No, it's actually 60% of the volume on Uniswap v3 is now sandwich attacks, and another 10% is arbitrage trading, which is fine. I don't mind arbitrage trading, but that means 70%, more than 2/3 of the volume on Uniswap is now bot oriented, and 60% is occurs at the block building stage. So it's a problem, right? If you are someone who wants to trade, and you say, I like this price, I want to trade at this price, please, you're now at the mercy of an extremely antagonistic environment, right? It's absolutely not, I hope, a surprise to anyone that the adversarial nature of blockchains really stresses the products that we build. And some of these, problems are very difficult to solve when you have a system that is determined, algorithmically, like an AMM. And so with Carbon, we said, okay, you know what? Why don't we just build a protocol ground up that allows people to make decisions in exactly that way, but not have to be subject to things like sandwich attacks, because the AMM has a predictable behavior. So we basically ripped out the AMM component, right? It's no longer an automatic market maker. It's very much a manual market maker. And I think Josh and I have we both share a similar affinity for the efficiency of order books. But at the same time, I don't like the idea of just creating an order book. I come from a background in invention and innovation. I'd say as an academic and an organic chemist. Like, I want to create things that don't exist or haven't existed before. And so if an AMM is a subset of an order book, then what I wanted to create was the next layer up, the thing that an order book is a subset of. And so this is what Carbon is, right? It is, sure, everything that you can do on Carbon, everything you can do on an order book, you can do on Carbon. But everything you can do on an AMM, you can also do on Carbon, right? We're about to expose on the front end. If you wanted to create a Uniswap v3 like position on Carbon, you can actually do that. If you want to create a Uniswap v2 style liquidity pool, you can do that. But you can also place explicit limit orders. And this doesn't require a hook. It doesn't require some weird contract interaction like I've seen in some of these other concentrated liquidity protocols, where there's an extra gas cost to the caller, who then has to pay the gas to exit your position for you and send tokens back to your wallet or anything like that. It's just part of the system, right? The limit order is a natural expression of the contract. It's not additional extra stuff that's kind of shoehorned into it as an afterthought. It was built with that purpose in mind. And more than that, it also has, and this is speaking to the stuff that's one layer up, the ability to create limit orders with money you don't even have yet, right? The ability to say, I want to buy ETH at $1,000 with an explicit ambition to sell it again at 1,100 or at 2,000 or at 3,000, whatever it happens to be. So when that trader is saying, I like this price because I have an ambition to sell it at this future price, you can actually just create a position on Carbon that does exactly that. And it's one touch, right? It doesn't require constant maintenance. It doesn't require the person who's creating that position to constantly monitor or change or adjust anything. There's no time sensitivity. It just is. And I think that it comes back to that argument that I was making about the way to view an AMM, if you want to view it as a positive thing, is to assume that that the LP likes the price that they got. And in an AMM, you can't make that decision for them, because there is going to be a subset of the market that was hoping that the price wouldn't move and that it would continue to earn fees. On Carbon, there is no such ambiguity. You told the protocol what prices you wanted to trade at, and those are the prices that we'll observe. You tell the protocol how to trade, not the protocol telling you how to trade. So it's a dramatically different system. I'd say it's almost the inverse of Uniswap v3, which is also good, right? Because you can flank your Uni v3 positions on Carbon and actually continue to trade well, even when your liquidity is moving out of range and things like that. So yeah, it's not a replacement for AMMs. I don't consider it a competitor to AMMs. It's more like a complement, right? It is addressing a shortcoming in the market technologically, that I think buttresses the rest of the Ethereum economy. So yeah, it's I'm really proud of it, and it's really exciting to see people engaging with it, learning to use it, and nothing but positive feedback so far.
Hell yeah, Carbon is awesome. I just one note. You are way too kind, Mark. You said 60%. I'm looking now. 60 is the low estimation for the percentage of volume. It's actually probably 70-ish, 70 to 80%.
Yeah, I always take the low estimate.
This is the product. Oh my god, disgusting.
Did you read Did you read my sandwich article, Josh?
No, please forward it to me. I would love to read it.
I'll
Thank
send it to you. I'm actually I'm about to publish part 2, so I'll send you the
hell yeah.
first one and then the other one.
Oh, please, thank you. All right, thanks everybody. I do have to run.
Thank you.
Have a great one, everybody.
Really enjoy having you. Look forward to next week and having you back. And I didn't mean to throw you on the spot at the beginning of the call. For all of the listeners, the Glassnode data that Mark was referring to, that Josh was commenting on, I did pin to the top. I also pinned Mark's article on and his research on sandwich attacks, along with a little bit more information on Aori and CarbonDeFi. Aori has their Discord link on their Twitter, and Carbon has our the Telegram. Oh, DeFi Cheetah, now you're joining. We're just ending the call. We have our Telegram link there. It is CarbonDeFi.xyz. Definitely look forward to having our panelists back next week. DeFi Cheetah, I look forward to speaking with you. I'm sorry we didn't get to catch up this week, but it's always wonderful hearing from you. So I look forward to our next call. Thank you to our speakers and thank you to everybody who tuned in.
Thank you, everyone.